Hey everyone, and welcome. If you've ever felt like building wealth is this super complicated, like 1,000-piece puzzle, you are definitely not alone. But today we're going to cut through all of that noise. We're going to simplify it all down to just two core engines, the only two things you really need to master to build serious financial momentum in your life. So the two engines of wealth. Let's kick things off with a big fundamental question. You know, it's so easy to feel completely overwhelmed by all the financial advice out there, isn't it? Everybody's looking for that one secret, that one little trick that's going to unlock everything. But here's the real secret. There is no single secret. Building wealth isn't a trick, it's a system. And I want you to think of it like a powerful machine. And this machine, it's powered by two engines that you, and only you, are in complete control of. Okay, let's pop the hood and look at our very first engine. Engine 1, your human capital. This is, without a doubt, the most powerful asset you already have. Now, what on earth is human capital? I know, it sounds kind of formal, maybe a little corporate, right? But all it really means is you. It's the economic value of everything you know, everything you can do, and all the experiences you've had. Your greatest asset isn't your money, it's you. And check this out. This chart just lays it out perfectly. On the left, that's what you put in. Your time, your education, maybe that online course you've been thinking about. In the middle, that's the result. Your skills get sharper, you become more productive. And where does that lead? Boom, all the way on the right. Your income starts to climb. I absolutely love this quote because it just nails it. Building your human capital isn't just about learning stuff for fun. It's about systematically turning what you could do into what you are doing, and more importantly, what you're getting paid for. It's turning your potential into your reality. So the next logical question is, okay, that sounds great, but how do we actually do it? How do we give this personal engine of ours more horsepower so it can generate more income? Well, the fastest way, hands down, is by focusing on high-income skills. Now, look at these salaries for a second. These are not just job titles, okay? I want you to think of each of these as a potential upgrade for your personal engine. When you invest time into learning one of these skills, you're making a direct investment in yourself. And the return on that investment, it's not just a piece of paper. It's a measurable, real-world boost to your earning power. All right, so Engine 1 is humming along, producing some serious income. That's fantastic. But earning more is only half the machine. Now we need to fire up Engine 2, your financial capital. This is where you make your money start working for you. And the fuel for this second engine is a little thing called compound interest. You've probably heard of it. People say Einstein called it the eighth wonder of the world. And honestly, he wasn't exaggerating. This is the quiet, relentless magic that allows your money to start making more money all by itself, even while you're sleeping. And if you need proof, just look at this table. It's honestly mind-blowing. At first, you might think, okay, 10% is just double 5%. And for the first few years, you'd be right. But look what happens after 30 years. It's not double, it is over 4 times as much money. That, my friends, is the insane power of compounding. It's an exponential curve. Now, as incredible as the rate of return is, there's another ingredient in this recipe that's even more powerful, and it's represented by this number, 10. A delay of just 10 years in getting your second engine started, well, it can have a truly massive and honestly devastating impact on your financial future. This short story just says it all, doesn't it? You've got investor A and investor B. They invest the exact same amount of money every single month at the exact same interest rate. The only difference is that investor A started a decade earlier. And that 1 decade head start, it allowed engine number 2 to work its compounding magic for 10 extra years. And it literally doubled the final amount of money. Time is your greatest ally. Okay, so fueling your future. We've looked at our two engines, human capital and financial capital. They are both incredibly powerful on their own, but the real magic, the life-changing stuff, happens when we get them running together. Here's the simplest way to think about it. Engine number 1, your skills, your career, that's your fuel factory. It's constantly producing the fuel, which is your income. But that fuel doesn't do you any good just sitting in a tank, right? That's where engine number 2 comes in. Your investments. That's the rocket that burns that fuel to launch you towards your goals. You need the factory and the rocket. So I don't want you to just watch this and think, that was interesting. I want you to feel empowered to take action.
So here is a super simple 3-step action plan you can literally start today. 1. Build Engine 1. Just pick one skill to start learning about. Don't get overwhelmed, just pick one. 2. Start Engine 2. Go online and open a retirement account. It takes about 15 minutes. 3. Fuel the system. Set up an automatic contribution, even if it's just $25 a month. The key is to start.
And for that second step, when you go to open that retirement account, you'll see options like a Roth or a traditional IRA. Don't let the jargon scare you off. An IRA is just an individual retirement account, a special type of account that gives you incredible tax benefits. For 2025, you can put up to $7,000 into one. It's basically a government-approved cheat code for building wealth.
So, as we wrap this up, I want to leave you with this one question to think about. You now know about the 2 powerful engines that you control. So, which one are you going to upgrade first? Are you going to focus on boosting your skills to increase your income? Or are you going to focus on getting the money you already have to start working harder for you? There is no wrong answer here. The only mistake is not starting. So let me know down in the comments, what's the first step you're going to take? I'd genuinely love to hear about it.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
You know, most of us think about investing as getting to some kind of destination, right? Like, there's this magic number you have to hit for retirement and that's it. But what if we've been looking at it all wrong? What if investing is really a journey with different seasons and, different needs along the way? Well, today we're going to map out that entire journey. We're creating a financial blueprint that can adapt and grow right alongside you. So let's just start with a really honest question. I want you to ask yourself, is the plan you have right now just for today, or is it truly built to carry you through everything that's coming next? It's a big question, I know. So let's dive in and find some answers together. And hey, before we hit the road on this journey, let's make sure we're all on the same page. You'll hear the word portfolio a lot. It's just a kind of fancy word for your collection of investments. All your stocks, your bonds, your cash. Just think of it as the vehicle you're building for this journey. And the best part is, you get to decide exactly how it's designed. Okay, let's get to the starting line. The very first leg of this journey is what we call the accumulation phase. This is probably where a lot of you are right now. You're building your career, your energy is high, and your single biggest financial asset is time. The goal here is super straightforward. Grow, grow, grow. Now, every single investor, and I mean every one of us, is in this constant balancing act between 2 big ideas: growing our money and protecting our money. In this early phase, with decades ahead of you, the scale is tipped way over to the growth side. And that means you can lean into strategies that have higher potential returns because you have time on your side to ride out any bumps in the road. So what does a growth-focused engine actually look like? Well, here's the classic example: an aggressive portfolio. See how it's mostly stocks? Stocks are the market's primary growth engine. So this is like putting your foot on the gas. This is for the investor who gets that there's going to be some ups and downs, but they're comfortable with that risk for the chance at much greater long-term rewards. But maybe, just maybe, you want a bit more of a smooth ride. Hey, nothing wrong with that. That's where a balanced portfolio comes in. With this 50-50 split between stocks and bonds, you're really aiming for the best of both worlds. You've got enough stock exposure to capture some really solid growth, but you also have a good chunk of bonds to act like a shock absorber when the market gets a little rocky. And then, of course, there's the defensive approach. Look, this isn't about racing, it's about making absolutely sure you get to your destination safely. By prioritizing bonds, which are generally way more stable, the main goal here shifts from maximizing growth to preserving the capital that you've already worked so hard to build. Okay, now this is where the rubber really meets the road. What I love about this chart is that it proves there's no single best portfolio for all seasons. It just doesn't exist. When the market is soaring, that's a bull market, the aggressive strategy is the absolute hero. But when things turn south in a bear market, that defensive strategy is what helps you sleep at night. The key here is that your strategy has to fit the economic weather and your personal stage in the journey. So let's move on to the next stage of our journey. After years of hard work, of saving and investing, you've built something substantial. Now, the landscape starts to change. The focus gently shifts from building your wealth to protecting it. It's about making sure it's there for you when you need it most. Welcome to the preservation phase. And this is where we have to talk about a hidden danger, something called sequence of return risk. Now, I know it sounds really complicated, but trust me, the idea is pretty simple. A big market drop in your first couple years of retirement can do way more damage than that same drop 15 years in. Why? Because you're taking money out while your portfolio is already down. And that creates a nasty double whammy that can be really, really hard to recover from.
So how in the world do you defend against that? Well, this is where a brilliantly simple idea called the bucket strategy comes into play. You basically create 3 separate pools of money. You've got your now bucket, which is cash for the next year or 2 of living expenses. Your soon bucket is for the next several years after that. And your later bucket, that stays invested for long-term growth. This structure is amazing because it lets you ride out a downturn without being forced to sell your growth assets at the worst possible time. It is an incredible stress reducer.
And that brings us to the final leg of the journey, decumulation. You've made it. You're now living off the incredible wealth you've built. But there's one more secret weapon you can use to make your money last significantly longer, and believe it or not, it has nothing to do with picking the right stocks.
It's a concept called tax alpha. I want you to think of it as a performance boost you give yourself just by being strategic. Instead of focusing only on what the market gives you, you focus on minimizing the bite that taxes take out of your withdrawals. Seriously, it's like finding extra performance hiding in plain sight, earned through clever planning, not just market luck.
Let me show you what I mean, because this is so powerful. On the left, you see a really common withdrawal strategy, just taking money from one account until it's empty. Look at that, it hit 0. The money runs out. Now, look at the right. This is a tax-optimized plan where you strategically pull from different accounts each year. See that? The portfolio just keeps going. The difference is absolutely night and day.
So, just how much of a difference are we talking about? In this specific analysis, just being smart about taxes made the money last almost 5 years longer. Just let that sink in for a second. That's 5 more years of security, 5 more years of freedom, 5 more years of peace of mind, basically created out of thin air, just by having a smarter plan. Incredible.
So let's pull over for a moment and look at the whole map we've just laid out. This isn't just a series of disconnected phases. It's one single, continuous journey that evolves as you do.
And here's the crucial takeaway, the thing I really want you to remember. A truly great financial plan isn't static. It breathes and it adapts with your life. You start by building with a strategy that matches your timeline and your comfort with risk. As you get closer to your goal, you shift to protect what you've built from those nasty, unforeseen risks. And finally, you plan to withdraw your money with intention and tax efficiency to make it last as long as you possibly can.
And this, my friends, brings us right back to you. After seeing this lifelong blueprint, take a quiet moment and just ask yourself, which stage of the journey am I in right now? And maybe more importantly, is my financial plan, is my portfolio truly aligned and ready for the road ahead? Because the journey is yours to design. Let me know in the comments, which stage are you in right now? I'd love to hear from you.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
All right, welcome back everyone. Today we're going to talk about something a little different. It's not just about how to save for retirement, it's about how to protect what you've saved. We're going to be talking about the hidden risks, the things that can haunt even the biggest, most carefully built nest egg.
So let's just dive right into this. You know, it's so easy to think that once you hit that big number in your 401k, you've crossed the finish line. But honestly, the truth is, just having a large balance isn't a guarantee that you're safe. There are these invisible forces that can completely throw your plans off track, especially after you've stopped working. So, to make this stuff feel a little less like a textbook, we're going to give these risks a name and a face. We're going to personify them. Think of it like a classic story, right? Once you can actually name your ghosts, you can figure out how to face them, and way more importantly, how to beat them.
Okay, our first ghost is inflation. This one is super sneaky. It's a force you don't always see day to day, but you definitely feel it. It's kind of like a silent thief that just quietly, year after year, eats away at what your money can actually buy.
So, what does this actually feel like when you're retired? Well, it means that fixed income you so carefully planned to live on, suddenly it doesn't stretch as far. The cost of your groceries, your healthcare, your gas, it all goes up, but your income stays the same. This ghost is literally giving you a pay cut every single year.
Now here's the really interesting part. This ghost doesn't haunt all of your investments equally. Stocks, for example, because they're tied to company earnings, which tend to rise with prices, they usually hold their ground pretty well. But look over at nominal bonds. Their fixed payments get chewed up by inflation, and their value can take a serious nosedive. Understanding this difference is absolutely crucial. And look, this isn't some far-off boogeyman we're talking about. A recent survey found that a full quarter of working adults had to cut back on their retirement savings, specifically because their living costs were going up. So this ghost is already out there, making things harder not just for retirees, but for everyone still trying to save.
Let's move on to our second ghost. This one is all about timing, and sometimes just plain bad luck. It's got a fancy name, sequence of returns risk, but it's probably one of the single most dangerous threats to someone who is just retired. The killer part about this risk isn't your average return over, say, 30 years of retirement. It's the order in which you get those returns. Just imagine this. The stock market has a huge crash the year after you retire. You're forced to sell your investments when they're at their lowest, just to pay your bills. That can permanently cripple your portfolio's ability to ever bounce back. And wow, this chart just lays it all out, doesn't it? Imagine retiring at the end of 2019. You're feeling amazing after a nearly 30% gain. And then, bam! Just a few months later, the market absolutely tanks by 20%. If you have to start pulling money out then, the damage is catastrophic compared to if that same drop happened 10 years later. You know, I saw this comment on a retirement forum the other day, and it just nails it. As you get closer to retirement, you just don't have the luxury of waiting years and years for the stock market to recover. And that is exactly why having a balance with less volatile stuff, like bonds, becomes so incredibly important. They act like a safety cushion, so you're not forced to sell your stocks at the absolute worst possible moment. All right, our final ghost is, well, it's a weird one. It's a paradox, really. It's the financial risk that comes from a really good thing, living a longer, healthier life than you maybe planned for. See, in the past, a lot of people had company pensions that would pay them for the rest of their lives. But today, the world has shifted to 401ks and IRAs. And that means the job of making one pot of money last for a totally unknown number of years, that whole job now lands right on your shoulders. It's a huge, huge challenge. 7 years. I want you to just let that sink in for a second. Studies show that on average, people underestimate how long they're going to live by more than 7 years. That is almost a decade of living expenses that you might not have a plan for. It makes this risk so incredibly easy to get wrong. And that's the real trap, isn't it? You face one of two bad outcomes. On one hand, you run the risk of completely running out of money. On the other, you're so terrified of running out of money that you pinch every penny and don't actually enjoy the retirement you worked so hard for. Either way, the plan didn't really work for you. Okay, so we've met the ghosts. They're scary, I get it. But here's the best part of this whole thing. You are not powerless against them. Now we get to the fun part. We're going to arm ourselves with a toolkit full of strategies to tame these risks and build a fortress around your future. Our first tool is the bond ladder. It sounds complicated, but it's not. Instead of just buying one bond, you buy several high-quality bonds that mature in different years. So you'll have one that matures in 2025, another in 2026, one in 2027, and so on. As each one matures, you get your money back, giving you this super predictable stream of cash. It's almost like building your own personal pension. But you've got to build this ladder right. The whole point is predictable income. So you want to stick with high-quality bonds and plan to hold them until they mature. And this last one is super important. You want to avoid something called callable bonds. All that means is the issuer can pay you back early, which, trust me, they'll only do when it benefits them, messing up your whole plan.
Next up in the toolkit, the living trust. This is a foundational piece of estate planning. The easiest way to think about it is like a special container that you put your assets into. You still have 100% control over everything while you're alive, but because the trust technically owns the assets, not you, they can pass directly to your family, completely avoiding the nightmare that is probate court.
And trust can get really, really smart. For married couples, this strategy is like a master-level move to protect your wealth. When the first spouse passes away, the trust automatically splits in two. One part uses up their estate tax exemption, shielding that money from taxes forever. The rest of the money goes to the surviving spouse, tax deferred. It is a brilliant way to make sure more of your hard-earned money stays with your family.
All right, our third tool is the Roth conversion. Here's the deal. You take money from a traditional pre-tax IRA or 401k, you pay the income taxes on it today, and you move it into a Roth IRA. Now, why on earth would you do that? Because once that money is in the Roth, every penny of growth and every withdrawal you make in retirement is completely 100% tax-free.
And this is where it gets really powerful, because this isn't just about you anymore. This is an incredible legacy planning tool. You're basically making the choice to handle the tax bill now, so your family doesn't have to later. By doing this, you can pass on an inheritance that your kids or your grandkids will receive completely tax-free. What a gift that is.
So there you have it. We've met the 3 hidden ghosts of retirement. But more importantly, you've now seen the powerful, practical tools you can use to take back control, to confront them head on, and to write your own story.
So let's put it all together one last time. You fight the ghost of inflation with investments that can actually keep pace, like stocks. You tame the ghost of timing with a balanced portfolio that includes bonds as a buffer. You manage the ghost of longevity with a realistic, honest plan. And you protect it all with your toolkit. Remember, saving the money is just step 1. Protecting what you've saved is how you truly secure your future. Hey, thanks so much for hanging out with me today. You now have a totally new framework for thinking beyond just saving, so I'm genuinely curious, after seeing all this, what's the one step you're thinking about taking to protect your own future? Let me know in the comments below. I'd really love to hear from you.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.